Hello there. Welcome back to Accounting Grade 10. We've got a question that we want to look at today. And this question is on concepts and calculations. So we're going to go through this question. Question 1.1 reads, match the concepts in column A with the explanations given in column B. Right? The letters only next to each number in your answer book. So we're given a column A, and then we're given column B. Column B has got the explanations that we need to match to terms that we are given in column A. So the first term that we have according to 1.1.1 is liabilities. So liabilities basically are these are amounts that we are owing, that as a business we are owing to other people or other businesses. So we call them liabilities. And then we can then subdivide these liabilities into two categories, whereby we've got current liabilities. Current liabilities, we are saying we are expecting to pay this amount owings within a period of 1 year. Then we say it's a current liability. Then when it's a long-term liability, we are saying we are expecting to pay this money after a period of more than a year. So we are going to stretch maybe the repayment period for a period which is going to stretch over a year. Then as long as it becomes over a year, then it becomes a long-term liability. So if you go according to the explanation that you are given in column B, the most appropriate that we are given there is C. This is the total of all long-term and short-term debts of a business. So the debts are the amounts that we are owing as a business to other businesses or other people. So these debts can be now long-term or short-term. So if we integrate this short-term and long-term debts, then we can have the total for liabilities. So basically liabilities, we are saying is long-term liabilities plus short-term liabilities. So this is what we have. So on the first part there, our answer is C. So we are going to put our C here. Then we go to the second one, fixed assets. But basically, we can start by defining what are assets. Assets are resources owned by a business, or resources that are owned by a business. We say they are assets. Although we can now go on to subdivide these assets into two classes, also whereby we are having current assets and fixed assets. Fixed assets, you can also call them non-current assets. Same thing. So on fixed assets, we are saying these are resources of the business that are going to stay in the business for more than a year. Then we can regard them as fixed assets. So good examples of land and buildings are fixed assets. Even furniture is furniture also regarded fixed assets. Equipment, fixed assets, etc. We have got many examples that you can give of fixed assets. So at the opposite now, when we are looking at the second class, which is the current assets, there are resources that are going to stay in the business for a period of less than a year. Is e.g. we've got cash and bank. Those are the examples of current assets, and also debtors have become also current assets. So here we are concerned with fixed assets. So the explanation that is matching fixed assets that we are having in column B, we would see that E is explaining, saying land and buildings and equipment are examples of this. So we have got E as our appropriate for 1.1.2. So here we've got our E. Then you go to 1.1.3, it's saying debtors. Remember, debtors, when you sell goods on credit, the people or the businesses that we are selling to goods on credit become our debtors. They owe us money. So these are debtors. So we can look at the explanations that we are given, the one that is matching that there. If you go to D, these are customers that buy goods on credit. So D become the most appropriate there. So we have got D. And then we go to 1.1.4 is saying the accounting equation. The accounting equation, remember, it has three main elements. We've got assets, we've got equity, and also we have got liabilities. And we can then present this accounting equation in the form of a formula. Remember, we can say the accounting equation is equal to the accounting equation is this the accounting equation that you are giving here. It says capital, assets is equals to capital plus liability. So here we have got assets, here assets is equals to capital plus liability. So this is the accounting equation that we have is in the form of a formula. So if you go to the option that we are given, you see that the most appropriate there that we are given is A. this looks at the relationship between assets, equity, and liabilities. This is what we have here. Equity, capital is representing our equity. Capital and equity, they mean the same thing. So here we've got assets, equity, and liabilities. So our A on 1.1.4, we have got A here. Then on the last one, which is the owner's equity. Owner's equity basically explains the money that has been, the money or resources that have been invested by the owner of the business for the operation of the business. Let's say the owner injects money in the operations of the business in the form of money. That money becomes also capital, or if the owner maybe brings in equipment, be it motor vehicles in the operations of the business, and the vehicle becomes operational in the operations of that business, then we regard that also as owner's equity. So if you look to the column B, the most appropriate that we are having there, we have B. This consists of the capital contribution and the profit made by the business. So on the second part, they are explaining about the profit. So the profit also that has been made by the business, that is going to be retained in the operations of the business in the form of retained income. It also increases the value of owner's equity. So you see that profits that are being made also increases the value of the equity that we are having, or the capital that we are having there in that business. So this is what we have. So B on the last part here, we have got B on the last part. Then we can move on to 1.2. If you move on to 1.2, 1.2 is saying choose the most appropriate word or words that complete each statement below. Write the only word, write the word only next to each number. So we are given their current assets, current liability, equity, balance sheets, creditors, investments, income statement. So these are the options that we are given. Then if you go to the beneath that, that's where we have got 1.2.1, and it reads dash are suppliers that sell goods on account to the business. So the suppliers, they are selling goods to us as a business. So when they sell us on credit, what do we call them? We call them creditors. These are trade payables or creditors. So here we can write our answer there as creditors. So creditors, these are people or businesses that we owe money, that we bought goods from on credit. So here we have got creditors as our appropriate answer there. Then we go to the next one. A bank overdraft is an example of a basically, maybe we can start by understanding what we mean by bank overdraft. Bank overdraft is a situation whereby the business withdraws money from its bank account, which is more than the balance that is in the account. We can give an example. Maybe the business has got 100 rands in the account, and business goes on and withdraw 150. It means they've withdrawn money which is above the balance that's there. So there's a deficit there of minus 50. So this one, the 50 rand here becomes the overdraft that is taken place. So they are saying a bank overdraft is an example of when we are now in the balance sheet, we regard it as a current liability because we expect to pay back this money, because it means now when there's an overdraft, we are owing the bank and we need to pay back that money, but we expect to pay that money within a period of less than a year. Then now it becomes a current liability. So here, the answer that we are having there is current liability. So we are saying here now current liability. And just create some space there. We are having current liability. Current liability. This is what we have in terms of 1.2.2. Then we can move on to the next one, which is 1.2.3. Right, on 1.2.3, the question reads, dash is a statement that shows the financial position of a business. We know that the balance sheet is the one that shows the financial position of the business. And when you look at the income statement as one of the financial statements that are prepared, the income statement now shows the financial performance of a business. But in terms of the financial position, it is the balance sheet. So the balance sheet, remember, it shows the balances between the assets, the owner's equity, and also the liabilities. So the accounting equation also explains the balance sheet. The elements of the accounting equation, all of them, we find them in the balance sheet. So that is what we have there. So 1.2.3, we have got the balance sheet. So here we can say balance sheet. Balance sheet. So this is what we have in terms of 1.2.3. Then the next one is saying a fixed deposit is an example of a. Maybe we can start by understanding what we mean by a fixed deposit. Basically, a fixed deposit is an investment plan where you can deposit your lump sum of money for a fixed period. When you deposit money for a fixed period, we regard that as a fixed deposit, and that money we expect it to earn interest. So when we have such a scenario, we call it a fixed deposit. So in terms of the rate of interest, also the fixed deposit will be having a rate of interest whereby we calculate the interest that we are going to add to the principal amount being the amount that we initially invested as a fixed deposit. So this is what we have in terms of a fixed deposit. So they are saying it's an example of a there. That is the question. We have to identify that what is it. It is an example of an investment. We can call it an investment because we are spending money. We are putting money there so that it earns interest. So whenever you put money and expect that money should increase its value or earn interest, we call it an investment. Maybe we can define the term investment so that we can understand how a fixed deposit is coming as an investment. So an investment is any situation whereby we are having an asset or be it an item that we acquire with the main goal of that that asset will generate income. So that becomes investment. It can also be explained from the point of view that it's an expenditure that we make today with anticipation that we are going to have a return in the near future. So then we can call that it's an investment. So in this case, we've got a fixed deposit. Money has been deposited in a fixed deposit account, and we're expecting that money will grow or earn interest and increase. So increase its value. So it's an investment. So 1.2.4, we have got investment. That is an appropriate answer that we can put there, investment. Then on the last one, the statement that shows whether the business has made a profit or loss is called a. This one is an income statement. An income statement is the one that tells us whether the business has made a profit or a loss. So here, income statement. So here we have got an income statement. So this is what we have in terms of 1.2. Then we can move on to the next one, which is 1.3. So on 1.3 now, there are calculations that we need to make there. Then we can start on 1.3.1. So here we can just say 1.3.1. In 1.3.1, we have got letter A that we need to find in B. So on B, we are given the gross profit. We are given the gross profit. There, before we calculate, we need to know this formula. That's cost price plus our markup here, will give us the selling price. And we need to know that the cost price is always 100% as a representation in terms of percentages. And then the markup depends on the question. Here we are told that on 1.3.1, the markup is 50%. So here we are saying plus 50%. And then the selling price becomes 100 plus 50, which is 150%. This is the representation that we are having in terms of the proportions in percentages. This is what we have. Then if you go to A now, A is asking us to find the figure for gross profit. We can also use use the formula for markup. We need also to know the formula for finding markup. Markup is equal to gross profit over the cost price. Gross profit over the cost price. This is the formula that we use to find the markup. So this formula can also help us find this figure that is A and B, or we can use from the angle of this formula of cost price plus markup is equal to selling price. So in this case, let's start with A. With A, it means here we can find the figure for gross profit using this formula. Remember, we are saying markup. Markup we are given it as 50%. Then gross profit is the one that we are looking for. And then cost price we are given this is 12,600. So we can present it in the form of this formula. Now we are saying our markup is 50% as a decimal becomes 0.5 is equal to our gross profit is the one that we are looking for, A, over our cost price we are given it at 12,600. So to find our A here, we are now saying we are now making A the sum of the formula there. So we can just simply say A, it becomes our A, we leave it this side, then we multiply by 12,600 both sides. Here you multiply by 12,600, and then you multiply by 12,600. We are trying to remove this 12,600 so that it becomes the other side. So we leave it like this. And this one will get 12,600 to get a 1. It will remain with A. Then this one now we are saying 12,600 times 0.5. So when we multiply that one, you get 6,300 rands. So it means here we've got 6,300 rands. So this is what we have in terms of the solution of 1.3.1. So 6,300 rands becomes our gross profit. So this is our gross profit. So this is what we have in terms of 1.3.1. Then we can move on to the next one, which is we are now on 1.3.2. Still on 1.3.1, we still need to find the figure for B. So let's try to find the figure for B. So B now we are saying this is our selling price. Remember, we are saying selling price. We say cost price plus cost price plus markup will give us the selling price. So there to find now the selling price, which formula can be most appropriate there. Let's try to see. We'll also use the formula that to find our gross profit. Also, we can say selling price minus our cost price, then we get our gross profit. Right. So the figure that we want there is the selling price, which is this one. We can make it the sum of the formula there, and it becomes selling price is equal to gross profit, and this cost price. We take it the other side, then we change the sign to become a positive, then it becomes plus cost price. So for our selling price, which is our B, we are now saying the figure for gross profit is the one that we calculated here, which is 6,300. We are saying 6,300. Then we add our cost price, which is 12,600. Which is 12,600. Then we'll do that. Let's try to calculate that one. We get 18,900. So it means here we've got 18,900. So this one becomes our selling price. So this is our selling price. So we can move on to the next one, which is 1.3.2. For 1.3.2, we need to calculate C and D. We need to calculate C and D. So how can we find our C? So according to the formulas that we are having there, we can just choose which formula is most appropriate to fit to help us find the figure for C. We help us find the figure for C. We can just use proportion there. Let's just use proportion. Remember, here we are saying cost price is 100%, markup is 50%, and then sale price is 100%. So we can just present it in that form. Then we come here. This is 1.3.2. So we can just say 1.3.2. And remember, we are saying our cost price plus our markup is equal to our selling price. And we said our cost price is 100, then our markup here is 50, and then our selling price is divided by 150. In terms of percentages, here we're saying it's percent, and percent. So we can just use proportion there, whereby we are saying our 150 is equals to 22,200. So we say 150 is equals to 22,200. And then the figure that we are looking for is C, which is the cost price, and the cost price is 100%. It's 100%. So it's the figure that we are looking for, question mark. So with this now, we can now find the proportion. This is the figure that we don't have. So what we don't have becomes the numerator. What we have becomes the denominator plus the given figure, 22,200. And then we say over 1. Then this is the simplest way we can use there. When we calculate that one, we are going to get 17,760. So here we are now having 17,760, and this is representing our cost price, which is C. So this is our C. Then we go to our D. Our D now is the gross profit. Our D now is the gross profit. And remember, gross profit, we said gross profit, we can find it by saying selling price minus cost price. Selling price minus cost price. If you come here, here is where we presented the gross profit formula. Here, gross profit equal to selling price minus cost price. So we can just simply do that. Now we've got selling price, we now have got cost price. So we are now on D. We are now on D. So D, we are just saying D is equal to our D is equal to our selling price is 22,200. Selling price 22,200, and this is our cost price, which is 17. This is 22,200 rands. Then we subtract our 17, which is our cost price here that we found here is C, 17,760. So this is what we have there. When we calculate that one, we are supposed to get 4,440. 4,440. Let's try to see. Let's try to calculate that one. Right. So when you calculate that one, 20,200 minus 17,760, you are going to get 4,440. So here you are getting 4,440. So this is our D. This is our D. This is our D. Simply that. Then I will go to 1.3.3. 1.3.3 and try to find out what we have there. We are now on 1.3.3. 1.3.3. So on 1.3.3, we are saying we are having F is the one that we want to look for, and it's our markup. And then we also have our E, which is our gross profit. So we can start with our F here, which is our markup. How can we find the markup? That is the issue here. But remember, in terms of representation, there we have indicated how we can represent those figures in terms of their percentages. We can see how we can start with E, which is our gross profit. Which is our gross profit there. It becomes simple now because we have our cost price, we have our selling price. So to find the gross profit, remember we use that formula that gross profit is equals to selling price minus cost price. So we are just saying this one minus this one, then we find our gross profit. So for F now, this is 1.3.3. 1.3.3. So it's 1.3.3. So on 1.3.3, we are just saying our selling price minus our cost price. If you go back, you see that selling price is 13,125, and then our cost price 7,500. So we are going to say this one minus this one, and then we get our gross profit. So we come here. We are now saying 13,125. Then we subtract our 7,500. Then we find our gross profit, which is equal to we get 5,625. So this represents our gross profit. So that is what we have in terms of 1.3.3 for the first part. So this is representing our E. This is our E. So this we are calculating our E. Then now we want to calculate our F. So F, let's try to find out what we have in terms of F. Here, when we come here, our F is here, it's our markup. Our F is markup. And remember the formula for markup is we say markup is equals to gross profit minus the cost price. So our gross profit is the one that we found there, and then our cost price is 7,500. So we can just go there. Remember, we are saying our markup is equal to our gross profit over our cost price. And then if we go down, you see that the markup that we found there, it's equal to the gross profit that we found there is 5,625, which we find here, found there, which is 5,625. And then we say over our cost price there, we found that is 7,500. And then this is the markup, so it should be presented in the form of a percentage. So if you calculate there, we calculate that one now. What percentage are we getting there? We find that our answer that you get there is 75%. So this becomes our markup. So this marks the end of this question. This is the last question that we are having on first question number 1. So thank you for listening. Let's stay tuned for more videos to come. Those who haven't subscribed, please subscribe and share. We'll meet again in the next video. Let's stay tuned and notified for the videos to come. With that, I will meet again, and I'm signing out.